We are very bullish on crypto assets, but we know that they are the most susceptible to liquidity drawdowns. And I described earlier, we have a number of reasons for liquidity drawdowns now, but we think that they will be cleared by the end of the year. And hopefully by December 10th, when the Fed eases. And hopefully when government statistics come back and we get the employment report in early December, which is the next time that I will have the pleasure of doing In the Know. So hopefully we're in the clear by then, and the bull market that we believe is firmly in place will continue apace.
The markets are uneasy, equities are wobbling, and crypto has turned defensive. But Cathie Wood believes this turbulence is temporary. Her core thesis: the recent stress is a liquidity event, not a structural breakdown. Liquidity has tightened sharply due to a combination of the Treasury's elevated cash balance and the Federal Reserve's still restrictive balance sheet policy. Yet, Wood forecasts these pressures will fade as quantitative tightening ends on December 1st. This, she argues, represents a de facto easing, a subtle but significant shift in the monetary tide. In her view, the coming weeks will mark a key inflection point. As liquidity returns, risk assets, especially innovation-driven equities and Bitcoin, could rebound decisively. What we're seeing, she suggests, isn't the end of the cycle, but a temporary dislocation born from policy lag and market fear.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
I know the markets are extremely nervous right now. The equity market and the crypto markets especially. And we think we understand why, and we also think this too will pass, because there are some very short-term reasons, mostly having to do with liquidity drying up, again, very short-term, associated with Treasury and Fed balance sheet, or the Treasury General Account and the Fed balance sheet primarily. And so we'll go into that in a minute. But we think that they will clear up within the next month. We have, first of all, quantitative tightening ending on, I believe it's December 1st. Now, many observers expected the Fed to end quantitative tightening with its last meeting. It did not. That was a little unsettling to the markets. And we're hearing from various Fed officials that there is more fear that inflation will not continue to unwind. We have a very strong view to the contrary. But the burden of proof is on us. The indicators have been sticky. Tariffs are one of the reasons, even though business has absorbed, we think, at least half of the shock from tariffs. So quantitative tightening, we think, will end December 1st. That's a de facto easing. S&P to gold. This one we've been watching like a hawk. Gold up, S&P wobbly. So you see testing. We do think it's going to resolve to the upside ultimately, especially if the chart I showed you earlier with gold price going down relative to money supply, if that is what happens now. The odds are high that it will happen because, as we saw from that chart, there are only two other times it's been this high. So we do not think it's going to resolve like the 70s when S&P fell relative to gold dramatically because inflation was such a problem. We think quite the opposite, deflation is. And here's an example of that. Price of the S&P relative to oil. The oil price is going down. That's a massive tax cut. That's good. And we think this will be a leading indicator of the S&P to gold. Here is the Treasury yield we saw the golden age. We had 40 years of declining long-term rates on balance. And that has changed. We didn't want them to continue going down. The quantitative easing and 0% interest rates basically suggested that the market was not working. We want the markets to work. We don't want the Fed to manipulate markets. And so the Fed is not manipulating anymore in terms of, certainly not in terms of easing. It may be too tight, and that might be what this chart is saying. We shall see. Bitcoin. Now, I was on CNBC, and the only part of the clip that I think taken out of my appearance was where I said that the biggest surprise to us over the last, since we started our research on Bitcoin into actually 2012, is that stablecoins are starting to usurp a role that we thought Bitcoin would play. We thought Bitcoin would be an insurance policy for emerging markets against confiscation of wealth, either outright or through inflation and other terrible policies. What has happened is the stablecoins are taking over. They've hit almost $300 billion. And so we think that that insurance policy role will take $200,000 to $300,000 out of our bull price, which our bull price, of course, was 1.5 million. And we're public with that. That's why I can say this. But that was in an all other things equal world. What has also happened, of course, is what we've been discussing. The gold price has doubled. So the gold market cap has doubled. And part of our analysis for the potential for Bitcoin was that maybe it would become half the market cap of gold. It would take some share from gold or maybe expand the market. That market has doubled. So I don't think our bull price should change all that much. And I probably should have been quicker to say all things equal on CNBC the other day. So I just wanted to clarify that. We are very bullish on crypto assets, but we know that they are the most susceptible to liquidity drawdowns. And I described earlier, we have a number of reasons for liquidity drawdowns now, but we think that they will be cleared by the end of the year. And hopefully by December 10th, when the Fed eases. And hopefully when government statistics come back and we get the employment report in early December, which is the next time that I will have the pleasure of doing In the Know. So hopefully we're in the clear by then, and the bull market that we believe is firmly in place will continue apace.
At the heart of Wood's analysis lies a contrarian conviction: deflation, not inflation, is the prevailing macro risk. While Fed officials remain hawkish, she sees clear deflationary indicators: declining oil prices, easing yields, and contracting liquidity, all pointing toward disinflationary pressure. Historically, such dynamics have preceded powerful equity recoveries once policy reverses course. She draws a parallel to the early 1930s, when the Fed's over-tightening triggered a deflationary bust. A subsequent easing unleashed massive gains in equities, particularly small caps. In crypto, Wood notes a structural evolution. Stablecoins are absorbing some of Bitcoin's original insurance function in emerging markets. Yet even after adjusting her bull case to reflect this shift, she maintains a long-term price target near $1.5 million per Bitcoin, underscoring that crypto remains a prime beneficiary of liquidity restoration and technological adoption in a deflationary world.
And then the various liquidity tightening moves have to do with the Fed reducing its reserves. We're now down to 6.6 trillion. And at the peak, I think we were close to 9 trillion. The Treasury General Account is at 940 billion. Normal over the last 3 years has been 600 billion. So the Treasury, because the government is shut down, is building cash and not releasing it into the system. The Fed has been very concerned about all of the easing and inflationary ramifications coming out of COVID, and they still are there, although they have been easing. Interest rates have been coming down since late last year, haltingly to be sure, but they are coming down. By some measures, and we'll go through the charts, while the Fed is easing, it is still quite restrictive. And so we need to hit that tipping point. And we do think that the next Fed meeting, which I believe is December 10th, will be the next decision, that the Fed will take interest rates down again. Now, I am a little concerned that we seem to have more hawks now building on the Fed. That's a bit of a change. We think that the labor market conditions are going to get worse, especially because at the end of September, I think the federal government let go 150,000 people, if I'm not mistaken. So they will get worse when they are reported. And I think that's going to change the dynamic considerably. So when will they be reported? Well, we need to get the government back to work. And the odds are, or the prediction markets suggest, that will be around November 17th. I did just see that Senator Thune is calling everyone back to work over the weekend on a continuing resolution. So it could be a little sooner than November 17th. But then the funds will be flowing again. So again, this is short term. I don't like what we're hearing from the Fed because I do think that they are missing some deflationary signals out there. And we'll get into a few of those. This is the ratio of the gold market cap to M2 and expressed in percentages. And what this is saying, given the rapid increase in the gold price during the past few years that we've seen, we wanted to assess, well, what does this metric look like relative to history? And what you can see here is two prior peaks near this level. One was in the Great Depression. And what happened is this peaked, I believe, in 32 or 33. And then it started moving down. We went through a reprieve in the Depression. Many people think it lasted throughout the 30s. It was at its worst in the early part of the 30s, or its most intense. And then in 1932, I think to 36, if I'm not mistaken, we had a reprieve and then a relapse in 37. During that reprieve, what we saw was money supply going back up. It had been declining, and the gold price was fixed back then. So all of this move was a function of money first declining. There was a deflationary bust, and the Fed wasn't picking up on it. And the Fed was fairly new. Or they wanted to make sure not to let inflation out of the bag. And so they tightened way too much. Money collapsed. GDP went negative. Pricing went negative. And you see here the gold price to money went up to its highest level ever. And then they started easing. And the stock market had one amazing move after that happened, with the smallest stocks the lower cap of the spectrum, having absolutely spectacular moves. So that's the first time this hit its peak, and then when it started down, we had a huge burst in the stock market.
Cathie Wood's framework hinges on one central pivot. Liquidity drives markets. With quantitative tightening set to end and the Fed likely to resume rate cuts by December 10th, she expects a renewed flow of capital into risk assets. Treasury reserves will normalize, government spending will resume, and liquidity will re-enter the financial system. For investors, this marks a critical window to anticipate policy transition rather than react to it. If deflation continues to surface, the Fed's tightening bias may prove not only unnecessary but counterproductive, creating fertile conditions for Bitcoin and innovation assets to outperform. In essence, Wood sees the current environment as a late-stage liquidity squeeze before an easing cycle begins. For disciplined investors, that spells opportunity amid fear. Stay focused, stay informed, and prepare for what could be the next major turn in the liquidity cycle.